Hey, good afternoon and welcome to another Mortgage Minute. My name is Jeff Harrison and we have a great show for you today with our favorite mortgage expert on the planet, Art Alvarez from MortgageWorks. We call the show Mortgage Minute because he keeps us up to the minute on what is happening in the world of mortgages. And we've got something special for you. In fact, I'm not even gonna blow it for him. I'm gonna let him do the talking about that. But there's been a lot of things going on. We've had a holiday and we've got things going on. It's now we're I think we're almost to the fall. I think the fall is around the 22nd or so of September, but things are cooling down for us a little bit in the desert. We've had some air quality issues, but for the most part, the temperatures have been kind. And I'm ready to get to that same point and see if we can get Art to nudge those interest rates down. So those of us that are anxious to get out there and buy a home can do so with a little better rate. But in the meantime, if you're hanging out and you want to renovate your house, Art is your guy. So let's bring Art in. Art, welcome to the show.
Thanks, Jeff. Good to see you.
Hey, how's it going? I understand you were busy today.
Yeah, I just got back from, I was a lunch sponsor and a speaker at the Greater Palm Springs Realtors. They call it Fast Start. It's a training, all-day training session for new agents.
Fantastic.
So
well, what do you see? I'm sorry. I was going to say, what do you see as far as new agents coming aboard? Is it pretty busy or so-so or?
No, it's pretty well. It's interesting. There's some kind of cross signals with that. We try to recruit new agents to join the Palm Springs Association by pulling a list from the California DRE because they publish a list of new agents, both new examinees and new licensees every week. And one of the things we've noticed is that on the new licensees list, the number of new licensees has actually dropped pretty significantly, which is not unexpected, with the market change, with rates up, with the real estate market kind of locked up, not enough inventory, less, total transactions being done. I think that's put a little bit of a damper on real estate as a career. And so you're seeing sort of a reduction in the number of new licensees that are coming out of the state. So.
Now, you've done this for a long time as far as mortgage is concerned. I mean, over 4 decades. Do you see the ebb and flow? Is this something just kind of like, is this just part of that ebb and flow as a pendulum swings back and forth where everybody becomes a real estate agent because the market is hot and then it starts to dwindle out?
That's exactly right. Yeah, it is an ebb and flow. The real estate business, both real estate and mortgage, it's a cyclical business. It's very up and down, and so as a consequence, new entries into the industry will change depending on what the overall conditions of the industry are at any particular time. And of course, it's been a couple of years now, or almost. It's been a more challenging time, and so as a consequence, you're seeing, I think, less people looking at real estate as the way to go versus other career options. So.
And as the sponsor, tell me about what kind of things you offer when you go in there. Do you help, some ideas about what you can help the agents with? Tell us a little bit about that.
Yeah, because I wasn't there just to feed them. I mean, I was the lunch sponsor, so of course I brought lunch in, but that's obviously not the real point. So I had an hour available for me to basically, talk to the agents about the industry, what's going on in the industry, and of course I took a little bit different tack to try to keep it lively and keep their attention. So, I'm in a networking group where I'll do presentations about the mortgage business and do some questions and answers with some trivia questions and those questions are designed to be able to, by answering the questions, be able to do some training. So I did that today, and it was actually well received. They were very pleased with it, and I think they learned a lot. So.
Fantastic. Well, I'm going to get out of here and turn it over to you, but I just want to remind those people that are joining us live, you can always leave a comment or a question in the comment section on Facebook or YouTube, and I'll be in the background, and I'll be feeding that over to Art if you have any questions. If you're watching this as a replay, please do the same thing. Art will follow up and get to you with an answer because, as Art will always say about MortgageWorks,
we have the answers, and they're on the house.
Art, have a great show.
Thanks, Jeff. Welcome, everyone, to this week's Mortgage Minute. Let's jump right into it. As you know, I like to talk about rates to start with, just to give you a little bit of a rate update. In that regard, what Jeff is doing here is pulling up our rate grid directly from our website. There you can see interest rate indications based on current conditions. As I always say, click that box at the bottom of the rate grid so you can get a better idea how rates are determined. As I've always mentioned too, your best benchmark to track mortgage rates is the 10-year bond yield. And it's been interesting. The movement over the last 5 days is something that's kind of noteworthy in terms of particularly the last couple of days with the bond yields. And in fact, one of the things I've observed is, for the longest time, it looked like the 10-year bond yield at about a 4% level was somewhat of a support level, that we were kind of hanging in at that 4.4% yield on the 10-year. Well, that support level has now moved closer to 4.25, 4.3. And Jeff just pulled up the chart over the last 5 days. You can see, end of last week, we were down, around 420, and then we got up around close to 430 most of this week until yesterday. And then yesterday it actually dropped a good amount, but then today back up. So what's going on there? Why did that occur? Well, on the 13th, that was yesterday, that was the first day where we had that movement downward in the 10-year bond yield. And it was an interesting reaction. Why? Because yesterday on the 13th, the CPI was released. That's a consumer price index. That's the inflation number. And, it came out at 3.7%, and which was higher than July at 3.2. So that means inflation ticked up. Now, normally when you see inflation tick up, you would see the bond yields not drop, but go up. But instead, after this 3.7 was announced, and of course it was described as a hotter number than expected, the 10-year bond yield actually dropped. Why? As I put in this slide, expectations. What I'm referring to there is sometimes, even in this case where the CPI came out higher in August than in July, the number that was announced was what was expected by the market. Forecasters had predicted that August was going to be higher than July for the CPI, and it came in exactly as forecast, 3.7. And what that means is, what's even more important than this number reflecting higher inflation is that the number came in as expected. And one of the things the markets don't like is surprises. They don't like the market, the stock market, the bond market do not like surprises. So even though the inflation number was higher than the month before, because it came in at the expected number, bond yields actually improved. But then today, not the case. Today, the PPI came out, the core PPI, that's producer price index, that's inflation at a wholesale level. The other economic points that came out today were initial claims for unemployment and retail sales. Well, the core PPI, the PPI both came out hotter than July, but a little bit hotter than expected. What happens? Bond yield kicked back up. Now we're back to around 430. The other thing I think affected bond yield today is retail sales. Forecast of 0.1, but actually was 0.7. So as a consequence, retail sales came in much higher than forecast, much higher than expected, thus the increase in the bond yield today. Because strong retail sales suggest the economy is still, very strong and, creates less of an expectation of a recession coming. And of course, we'll see some more of this tomorrow when industrial production comes out. 0.2 is forecast for August. It was 1.0 in July. So that means the forecast is for industrial production to come in much lower than July. If that proves to be true and comes out as forecast, I would expect bond yields to improve and come back down. So for those of you who track this daily or almost daily, you might want to take a look at the 10-year bond yield in the morning and see if that industrial production number does help us get that down. So that's where rates are right now. So at this point, what I want to do is go into the issue of credit applications. I saw an interesting article that had a headline that caught my attention. This was actually published in Scripps News on September 12th. And the headline was, "Applying for credit, ? Be prepared to be rejected." And of course, the subtitle there, you can see a new survey found that the rejection rate for credit applications increased to 21.8% in June. the highest it's been in 5 years. And in reading the article, one of the things it pointed out is these kinds of numbers, these reject rates, were hitting those with credit scores under 680 the most. And the kind of credit applications that were discussed in this article included credit cards, auto loans, and mortgages. And it was credit cards and auto loans that tended to have the higher decline rates. One of the items that was particularly caught my attention is credit card limit increased requests. Many households have been requesting increases in their credit limits on credit cards. That's not a surprise. We keep saying it's been big news. It's still news. Credit card debt now is over $1 trillion in the US, all-time high. And so with that number, it's not a surprise that more households are applying for or requesting increases in their credit card limits. What that tells you is a lot of those households may be maxing out their cards, which is why we're over $1 trillion in credit card debt. And that's a little bit scary because on the one hand, we're seeing these numbers that suggest retail sales, for example, still very strong. Well, the credit card limit increase request decline rates, 30%. So basically 1 out of 3 households who are requesting their credit card company to increase their credit limit on their card are being turned down. And so I think overall what this is suggesting is while retail sales continue to be strong, the consumer spending economy appears to still be strong. The watch out for is it seems to be fueled by purchasing by credit card. That means households are spending money they don't really have. They're borrowing it. And as a consequence, credit card companies are starting to rein in credit applications as well as credit limit increases to try to keep that under control. And given that the fact that this article had mentioned that the credit score borrower under 680 has been hurt the most by these reject rates, I wanted to remind everybody, since I've been talking a lot about equity loans, that we can help that borrower. Not very many, or at least a lot of the equity loan lenders, the banks, even credit unions that are offering HELOCs or fixed rate seconds, in many cases, it's hard to find lenders who will offer financing, equity lending to borrowers under 680. So I want to make sure you know we have an option for that borrower. We actually have HELOCs available with a minimum credit score down to 620. We can arrange a HELOAN, that's a fixed rate second, with a minimum credit score of 640. So if you're a homeowner with a credit score in that 620, 640 range, you've got a lot of equity, you'd like to tap into that equity, you need or want an equity loan, but you're getting told no by the major banks, maybe even some credit unions, give me a call. Let me know what your needs are, what you're trying to do in terms of an equity loan. I can give you a quote because we can definitely help those homeowners that are under 680, again, down to 620 for a HELOC, down to 640 for a fixed rate second. We can help you, give you an option so you can still tap into that equity as you need to. The other thing in that regard I want to make sure you're aware of is we have equity lending for rental property, and that includes owners of rental property with under 700 scores. We can arrange HELOCs for a rental property with a minimum score of 680. We can arrange a fixed rate second. Again, we call that a HELOAN with a minimum credit score of 640. So if you've got rental property or rental properties, but you're a little bit challenged on score, you're under 700, we have options for you. So be sure to keep that in mind. Check us out. Be happy to send you some numbers. Now, given I'm just talking about the credit card rejection rates and the fact that we can still help homeowners with credit scores under 680 get an equity loan, which oftentimes will be used to consolidate that credit card debt, I wanted to share with you a question that we got after one of our recent episodes. So I wanted to provide you that question or show you the question that we got. Actually, there was 2 of them, and then I'm going to go ahead and answer them. The first one that we got was, when I qualify for a home equity line of credit, are there any restrictions on what I can do with a new source of funds? Well, the answer to that is, generally speaking, no. I mean, when you're getting an equity loan or getting an equity line of credit, those proceeds from that loan can be used for just about any purpose. There's really no restrictions per se for how you use that money. Now, of course, you don't want to use that money for anything illegal, And one of the most common things that we were asked is, can you use that money from an equity loan or from a HELOC? Can you use that to finance the purchase of another property? Well, that's a tricky question because on the one hand, as I think I've covered on a recent episode, we talked about the fact that if you're going to be purchasing a home or maybe another home, that secured borrowed funds is an acceptable source of down payment. So mortgage lenders will readily accept that if you're going to purchase, let's say, a rental property, and you're going to take a loan out on your current home, like a HELOC, and use the proceeds of that to purchase that rental property, use the proceeds for your down payment, the lender funding the rental property loan will accept that. It's okay because you're borrowing against your primary home that secured borrowed funds. And so that is an acceptable down payment source for the purchase of that rental property. Now, that equity loan that you took out will be taken into account in terms of the monthly payment on it and included in the debt ratio on the purchase loan you're getting for that rental property. So that will be taken into account. But otherwise, that lender funding the purchase loan for the rental property has no objection to you using the HELOC as your source of the down payment for the purchase of that rental property. However, on the flip side, when the HELOC is being arranged, it's a little tricky to, in that HELOC application, tell the HELOC lender that the reason you're pulling this money out is because you're going to go buy another property. That's a little tricky. The reason is because if you just put that out there in your application, tell them that's what you're going to do, you may be asked to provide evidence of what exactly you mean in terms of, do you have a current transaction you're about to start? Are you already into escrow? That can be a little bit problematic because then that HELOC lender, if they know you're going to use that money directly to go purchase that other property, they may want to try to use that other property purchase and pull it into qualifying for the HELOC, even though that purchase isn't done yet. So in that regard, we usually try to tell folks you want to steer clear of necessarily suggesting that you're going to use the proceeds of a HELOC or an equity loan to purchase another property. Or to the extent you're thinking about that, put some space between the two. Certainly don't open escrow on the purchase of a home, and then after you do that, hurry up and try to get a HELOC in your primary home. That could be a little bit problematic. But otherwise, there's really no restrictions on what you can use the proceeds from an equity loan. Again, whether it's a HELOC or a HE loan, you can use that money for almost any purpose. However, I did read an article here recently where a homeowner who was taking out a HELOC was taking the proceeds and sending those proceeds to buy virtual currency. And that actually triggered a SAR report. That's a strategic activity report. And the reason is because apparently some homeowners have been caught up in a scam where they've been encouraged to purchase virtual currency and to do so by either using existing funds from other accounts or even pulling equity out of their home, such as through a HELOC or a fixed rate second, and then using those proceeds to buy more of this virtual currency. And of course, what that homeowner sadly finds out later is it's all a scam and that money's going to be gone. So for anyone who's contemplating a HELOC to pull equity out to buy virtual currency, be careful who you're dealing with and make sure whatever that virtual currency you're purchasing is legitimate. So with that disclaimer, let's also talk about the other question that we got here this week. What obligations do I have at time of closing the loan? In other words, how much must I take? Common question. With HELOCs, in the old days, not too many years ago, we oftentimes would arrange a HELOC for a buyer of a new home. And we would oftentimes say, hey, tell you what, since we've got your package anyway, we're getting ready to close your purchase loan. Maybe after you complete that purchase, you've got some equity because you put in a large down payment. Why don't we arrange a HELOC for you? You can just put it in place and it can be your rainy day fund. You don't have to use it right away. You don't have to draw on it right away. It can just sit there. And if you need money in an emergency, you can tap into it. So frankly, we used to do that quite a bit. Why? Because back in those days, HELOC lenders in general would not require that you take any kind of draw on that loan at the time it was closed. Those days are pretty much gone. So now if you're going to get a HELOC, there is generally going to be some minimum amount of draw at closing that you're going to have to take. With the HELOCs we arrange, at least two of the programs that we have, your minimum line of credit for HELOC has to be $50,000. And in that regard, the minimum draw for those two HELOC programs that we have is $50,000. And with one of them, you have to draw $100,000 to get the best rate on the HELOC. Now, why is that? Why is that a requirement when it wasn't before? Well, the reason is HELOC lenders figured out that in the past, homeowners would get a HELOC and it would just sit there and not get used. Well, that doesn't make any money. There's no profit for the lender in that situation. They front loaded their costs to underwrite and fund the loan, but they're not earning a yield on that loan because the homeowner chose not to use it, at least not right away. So those days are gone. HELOC lenders now happy to arrange the loan, but they don't want to arrange loans that aren't going to be used right away. So generally speaking, when you're getting a HELOC, plan on you're going to have to draw at close. In most cases, it's going to be $50,000. In some cases, to get the best rate, it's going to be $100,000. In one of the lenders we have, the minimum draw is $50,000 or 3/4 of the credit limit amount, whichever is whichever is higher of the two. So if you're getting a $100,000 HELOC, you can't just draw $50,000 to satisfy the lender. You got to draw $75,000. So just keep that in mind, that you do have that obligation to take a minimum draw at close. Now, if you don't need all of that money after closing, then what you can do is take the portion that you don't need right away and send it back when you get your first monthly mortgage payment statement. So that's usually what we tell folks to do. Now, if you're talking about a HE loan, a fixed rate second, it's kind of a non-issue, because with a HE loan, it's a traditional fixed rate loan, and you get all your proceeds in a lump sum at closing. And of course, it's not the type of loan instrument that you can use again, that you can draw against like a HELOC. So with a HE loan, this is not an issue to even be concerned with. This question is geared solely to a HELOC and the fact that you do have to draw some funds right away. So the lender, frankly, has an opportunity to earn a yield and make a profit on the loan. So you have to consider that's probably a reasonable stance for HELOC lenders to take. They're not in the business of just giving you a loan instrument that you're going to sit there and not use and let it just get dormant and not allow the lender to earn any yield other than the annual fee that they might charge for maintaining the account. So those are good questions that we got this week. I was happy to answer those. I hope that clears up a little bit of what your obligations are when you get a HELOC. When you do get one, be sure to plan on taking a draw when you do. As my next subject, I wanted to cover what is something that I'm actually dealing with right now. It's a very interesting scenario. I wanted to share it with you because I think there's a few lessons to be learned here. And I call it Reverse Mortgage to the Rescue, a case study. So let me tell you a little bit about what I encountered recently. And this is a particular situation I'm dealing with and trying to help a homeowner with right now. I recently came into contact with a senior home buyer, someone who recently purchased a home. She's 77 years old and a widow. And she purchased a home, in California, Southern California, coastal area, for $1,055,000. She put 25% down. And the loan amount with that 25% down payment, $791,250. And she tells me that she was in need of closing very quickly. I don't know why that was, what the circumstances were behind that. But in any event, she explained that when she got this purchase money loan, that she had really no choice but to take the loan that she was offered because of the need to close quickly on the escrow. But what I learned is the particular loan she got had terrible terms, outrageous terms. I mean, to the point that, as I put in my slide here, I question whether or not this is an example of elder abuse, because frankly, the homeowner really didn't have a complete grasp of what kind of loan she was given. I was able to, get a copy. She shared with me a copy of her final closing statement, and the loan terms that she obtained were just horrendous. Her interest rate, 9.5%. The mortgage originator charged her 2 points. Well, on $791,000, that's almost $16,000 in points. There was another $2,000 in lender and broker fees. And then to top all that off, she's gotten a couple of follow-up messages from the loan originator telling her that there may be a 1 or 2 year balloon payment on this loan, which is really scary. Now, those kind of terms, what that means is her housing expense on a monthly basis is over $8,000 a month. That's for principal and interest, taxes, insurance, and HOA dues. The property she bought is an attached PUD, a planned unit development, so it's in a gated community, and it does have HOA dues. It's not a condo, it's an attached PUD. And so in interviewing her and trying to help her, because what she did is she was referred to me to immediately try to refi out of this bad loan. And in interviewing her, I found out she has pretty limited income, about $1,500 a month in Social Security, about $1,300 a month, $1,300 a month in some sort of pension coming out of Canada associated with her late husband. But the good news is she had nearly $1 million in liquid assets, about $90,000 in a checking, about $900,000 in an investment account. She still had that left over after she spent that other almost $300,000 to complete the purchase of the home. I quickly determined she was not going to qualify for any kind of conforming loan, nor even qualify for a non-QM, a non-qualified mortgage, low doc option, like using bank statements or a P&L only or any of these other non-QM options. She simply would not qualify for any of them. But what occurred to me, what dawned on me is, as a 77-year-old homeowner, the potential solution would be a reverse mortgage. So I discussed that with her, and that's what we're pursuing. So what we're looking at doing now is refinancing with a HECM, that's a home equity conversion mortgage, the technical name for most reverse mortgages that are made today. Again, that's an FHA product. And so what we're looking to do is we're going to refinance her home with a HECM reverse mortgage. Now, one issue with that is, given the fact she's 77, it is $1 million home, but most reverse mortgages, when you get them, are only going to give you proceeds of maybe around 40, maybe 50% of your value. So in this case, the HECM reverse mortgage amount she can get is not going to be sufficient to pay off that terrible loan. So she will be required to provide almost $350,000 at the closing of the HECM reverse mortgage in order to cover the payoff shortfall. But the benefit is, by doing that, is then going forward, she will no longer have a mortgage payment at all. This means she will be able to avoid and eliminate about $6,600 a month in principal and interest payment on this terrible purchase loan that she got. Now, she still has to pay her taxes, still has to pay her insurance, still has to pay her HOA dues. And yes, her $900,000 investment account is going to be more like $550,000 to $600,000 remaining. But that should give her still a pretty good cushion, given that she's going to eliminate that $6,600 a month in principal and interest payments. So the moral of this story is, number one, senior homeowners, if you can, you really got to be careful of what you're being offered and try to get second opinions to make sure you're getting the best option available for you. What I discussed with her is, in reality, in hindsight, she should have looked at a reverse mortgage as the mortgage instrument to use to purchase the property, because you can use a reverse mortgage to purchase it. But again, she was led to believe, maybe pressured to believe, that she had to close quickly. And so never occurred to her that a reverse mortgage to be used for the purchase would be a good option for her. She knows that now, but of course she already owns the home. So at least now we can use the reverse mortgage to essentially save her from this very bad loan. So the bottom line in there with this scenario that I want you to know, and this is something we really take pride in, and we really focus on trying to be a help to senior homeowners and home borrowers. Just keep in mind that for the senior borrower, MortgageWorks does have the answers, and they're on the house. So I thought you'd be interested in that case study. If you know any senior homeowners or senior home buyers who are looking to get a loan, encourage you to have them talk to us just to get a second opinion. we'll help sure that they're going to get a loan that best suits their needs, and most importantly, is going to be safe and not a ripoff to them. Okay, so with that, I want to go to our closing question from last week. Can a no cash out refinance be used to buy out the ownership interest of another title holder? And the answer is yes. And what I put here is I've given you a bullet point of the guidelines from Fannie Mae. Now, as I've mentioned many times, with the rates where they're at, mortgage refinancing activity is way, way down. The one segment of mortgage refinance activity that has some life to it is cash out refinancing. But in this case, you notice I'm referring to no cash out for this particular circumstance. So let me explain why that is. Well, Fannie Mae does allow for a transaction, a refinance, where one owner is buying out the interest of another owner. Where do we run into this the most? Divorce or dissolution of partnership situations. I usually do a couple of these every year or more. So if you have a case where a married couple or domestic partners are splitting up, they own a home together, one of the parties decides they like the home, they want to keep it, but the other party or spouse wants to move on. What you can do is we can arrange a refinance loan to pull cash equity out of that home to be used to buy out the ownership interest of the other owner who is not going to retain ownership and who's going to move on. Now, in a case where the property is jointly owned, and we're going to look to do this, the property does have to be jointly owned for at least 12 months preceding the loan. Now, is there an exception for that? Yes, if the property was inherited. Because in that case, if, let's say, siblings inherit a home from their mother or father or parents, in some cases, one or more of the siblings may want to keep the home, either to move into it or maybe they want to keep it and rent it out, whereas maybe the other sibling or siblings don't want to keep it. They want to get their money and cash out. So with an inheritance, the 12 months preceding ownership requirement is waived. And if you've inherited a home, let's say with your siblings, and one or more of you want to keep the home, you can get a refinance to pull the cash equity out to be given to the other owner or owners who don't want to retain ownership and want to move on. And in order to do that, whether it's a divorce or an inheritance situation, you do have to have a written agreement that describes the transfer of the property, from who to who, and the disposition of the proceeds, most specifically how much is going to be required to buy the ownership interest out from the other owner. And the reason this is a good thing to do, and the benefit of this type of transaction, is even though technically you're pulling cash out, it's not treated as a cash out refi from an underwriting perspective. So that means you're going to have a little bit easier time in qualifying. And most importantly, the pricing of your loan is going to be better because you're not going to be subjected to the price adds, most specifically rate adjustments, because you're doing cash out. Because a cash out refi generally is considered a risky transaction or a more risky transaction to a lender. But the exception to that is if you're pulling cash out because you're buying out the ownership interest of another owner, either through a divorce or an inheritance most commonly, then it's not considered cash out for purposes of arranging the loan. So you're going to get that better rate that you would have gotten if it was treated as a no cash out refi. And oh, by the way, the FHA guidelines on this are very similar. So there's your answer. It is possible to get cash out of your home to buy out the ownership interest of another owner, but it's not treated as cash out, and therefore you're going to get a better price on the loan. You're going to get a better rate. So that was a good question. And with that, well, let's go into our closing question for next week. Pretty simple one. And this is one I usually get asked about every year or two. Can rent received from boarders be used as qualifying income? Again, can rent received from boarders be used as qualifying income? So ponder that question, and next week we'll give you the answer. And of course, it'll be on the house. Jeff, back to you.
Art, what a great show. That was a lot of good information you shared with us this week. For those of you who are interested in the refinancing, or not refinancing, but for home equity line of credit or the reverse mortgage, the information on the screen is where you'll contact Art. And it's 760-883-5700. That's his office number, or his cell phone is 614-612-9035. Now, Art, when it comes to that cell phone number, you always have that on you, do you not?
It's with me always. Well,
fantastic.
One exception. I'm pretty much a daily visitor to the gym. And so my 1 hour of solitude is I do not take my phone into the gym.
So now do you take that phone to the gym and then give it to the attendant in case there's an emergency call? You can take that call?
No, actually I don't. Maybe,
okay.
That's a good point. Maybe I should do that. But I've always figured that, 1 hour of my time, or hour and a half, depending on how long I'm in the gym, I usually figure, well, that's a short enough time I can afford to not be reachable. But I just don't want to walk around the gym, looking at my phone all the time, as I see people do all the time. It's like, I'm in the gym trying to get exercise. I don't want to get a hunchback because I'm in the gym looking at my phone all the time.
That's a good point. And, so if you're accessible 23 hours a day, I think that's fair enough. That's right. Fair enough. So Art, I really liked the way you shared that reverse mortgage case study, and the fact that it was real life. You're actually working on that now. Is that what you said?
Yeah, we just originated the loan. So we're in the early stages of the reverse mortgage process. But, I was just completely dumbfounded by this story. And I learned of it actually from a real insurance agent who's in my networking group, who had called me with a question about the homeowner's insurance that was arranged on the property, because that was a whole nother part of the transaction that got off the rails. And it turned out the wrong kind of insurance was placed on the property at closing, which also was associated, I think, with a misstep by the mortgage originator who arranged the purchase loan. And so that's when I first learned of the transaction. And the insurance agent had mentioned to me that her client, the homeowner, felt she had gotten a very bad loan. And so the insurance agent wanted me to talk to the homeowner and see if I could help. And of course, once I did, I was just horrified by the story. And I just think that what she was provided was just criminal. I mean, you should not do that to a 77-year-old home buyer. And so it became my mission to figure out what was the best way I can get her out of this loan as quickly as possible. And of course, the reverse mortgage, while not maybe the best option overall, because she's got to pull more of her liquid assets out, to cover this payoff shortfall to get rid of this bad loan, I think in the long run is still going to be the best thing for her to do.
Well, the fact that you totally eliminated her mortgage payment, as you said, she has to pay your taxes, insurance, and homeowners, but that eliminated the bulk of that extra monthly expense. It was, let's face it, when I did the numbers, I'm like, well, that's not going to last very long.
Well, exactly. I mean, with the existing loan that she has at over $8,000 a month, all in with the associated expenses. I mean, think about it. She's going to blow through $100,000 a year of her $900,000 investment account just covering her housing expense, let alone just living expenses and trying to, groceries and gas and whatever, all the other things that go with just living your life. I mean, that's a recipe for disaster. And so it became readily apparent to me I had to get her out of that situation as quickly as possible.
Wow. Well, that's a leads up to this point. If you have a question and you put it in the comments and it is chosen online, Art will answer it as he did with the other question when it came to the HELOC and how could it be used and what is your obligation at the time that you close the loan. I think that's very beneficial. Thanks for doing that today, Art. Again, if you need information and you're ready to make a move, as far as the big thing is, I think last week you said HELOC loans were up 52%, mostly because people were staying put because of the rates, and they were renovating the homes they lived in. So if you need help with that, you can contact Art at 760-883-5700, or again, on his 23-hour, I'm available almost anytime, cell phone, 714-612-9035. You can always go to the website and check out what the loan rates are. So the reason I want to point that out, Art, is because often our headlines will say, hey, rates are above 7%. I saw that you were in that 6, that you were under 7 for the rate. So I think you want to make sure to check that out on the rates. And then, of course, you can always call or get a hold of Art at his email at art@mwloan.com. Any last moment messages, Art, before we let you go today?
Well, just on that point, Jeff, I forgot to mention, I saw it again this morning on CNBC. They had 30-year mortgage over 7. Not true. Don't let them tell you that. You've got a good credit score, decent down payment size. We still have rates for conforming loans under 7%. So if you're thinking 7 is all you got, check us out because we have an option for you in a lot of cases.
Art, thank you again. We'll see you next week on the Mortgage Minute. My name is Jeff Harrison. Art, I'll turn it back to you.
All right. Thanks, Jeff. Thanks, everyone, for watching and listening. Stay tuned next week for another edition of Mortgage Minute. So long and take care. Bye.